Hello and welcome to Fund to Money. Here we will be discussing why it's a smart move right now to get into a systematic transfer plan (STP). If you're a mutual fund investor and have invested in high growth investment, which could be equity funds, equity oriented funds, and with the threat of volatility, you're already seeing market volatility that would be affecting your investments. Or the fear in certain quarters of market correction, you would want to secure your gains. You would like to make sure that your investments you're invested in you want to make a correction adjustment in the risk levels. Then systematic transfer plan, STP, in mutual funds is useful. This is a facility in mutual funds where you can transfer systematically your money in your investment in one particular fund to another fund. So in this case, you're moving from a higher risk investment, higher risk fund to a lower risk fund. So that is basically what you're trying to do when you are opting for a systematic transfer plan. And there are a whole bunch of benefits. Right now, there are quite a few benefits, and we'll be discussing them one by one. And of course, we'll cover some of the key things that you need to keep in mind. So, we'll come back with some of the points, some of the important points that you need to keep in mind, and some of the details. Don't go away. Welcome back. Welcome to Fund to Money. We are discussing why STP or systematic transfer plan is the way to go right now. If you have already made some substantial gains in mutual funds, equity mutual funds, equity oriented funds, you might be feeling uncomfortable about the risk levels. Because markets might be with markets going up and down, you might be feeling uncomfortable. So STP is something which will help you sort of adjust the risk levels. Also, if your goals are around the corner, say retirement is around the corner, children's higher education is like 2 years, 2.5 years away, 1.5 years away, and you want to secure your investment, make sure the gains are there for you to use when your children are going to college, then systematic transfer plan is the way to go. It's a facility where you move money out of a particular fund, mutual fund, into another one. Of course, you're moving from a higher risk fund to another fund, a low risk fund. So let's talk about some of the things that how it helps, and how some of the things which will help, which will be helpful to you under the current circumstances, right? So first, of course, as we mentioned, there's been a huge market upswing. You made gains. Now you want to secure those gains. What better facility than systematic transfer plan or STP, because you can move from an equity or equity oriented fund to a low risk fund, say a floating rate fund, or depending on what kind of requirements you have, you can choose a debt fund, or if your goals are way ahead, there's a lot of time, you can move from an equity fund to a hybrid sort of a fund. So that's something that that is helpful. You can do the gains. You can take the gains part of it and take them to a lower risk fund through a systematic transfer plan, where certain amounts are regularly getting transferred to a low risk fund. Or you can take the whole part of it. You can take the capital gains part of it. So there are variations. We'll discuss it a little more a little while down the line. So that's number one. Number two is your rebalancing happens on its own. So what happens is you had invested in equity oriented funds. Market upsurge happened. You made gains. Now what has happened is you're basically, the weightage is now more towards equities, and this could be far more. The risk level would be may well be far more than you're comfortable with. So you want to correct the balance. Suppose you were comfortable with 60% in debt and 40%, rather 60% in equities and 40% in debt. or you're comfortable with 75% in equities and 25% in debt, and now it's gone way up. Now you want to correct it. Now the way to do it is you use the systematic transfer plan, take some of the money into a lower risk mutual fund. It could be a debt fund or what have you, whatever you're comfortable with, and you can correct it. And so the rebalancing happens on its own, and the risk level is adjusted on its own. So what it does is, whatever strategy you had in terms of how you're going to invest in different asset classes, it brings it back on track. And whether it's market upsurge or whether it's markets are going down, you need to do this portfolio rebalancing. Then of course you can make a nice transition from a high return, high risk, high return sort of a strategy, or shall we say a situation. From there you can go to a steady return. So you don't want to get affected, lose your sleep when markets are going up and down. So you can look for, make that change through a systematic transfer plan, so that you can go into a whole system or a whole situation of steady return. So you're going towards it, you're doing something so that you can get some steady return. So the other thing about systematic transfer planning, you do not have to time the market, right? You don't have to look for the time when the markets are going down and then you try to take money into a lower risk investment. You're doing it on a regular basis, we're doing it steadily. So you don't have to worry when the markets are going down. You are doing it on its own. It's pretty much like systematic investment plan in that sense, because you're doing systematically, you're investing, therefore you don't have to time the market, right? And also like systematic investment plan, because you're moving the money in a systematic manner. So what basically is happening is that the same advantage, rupee cost averaging advantage you're getting. So you're buying more units when the markets are down, less units when the markets are up. Over a period of time, the average cost comes down, and when these investments appreciate, you make the gains that you want. So this advantage also you get. Apart from that, what a systematic transfer plan also does, it helps you in case your goals are imminent. So your children's higher education, college is around the corner, or university is around the corner, or your retirement is around the corner. It helps you get the money, secure the gains or the whole amount, and park them in a low risk investment option, from where you can have regular income, or you can have lump sum, or a combination of both. Typically you would put it in, say, if it's very near, is a very short term sort of a debt fund, and maybe an arbitrage fund. And in case of a debt fund, you might want to get a systematic withdrawal plan to get you the regular income. So these are some of the things that you need to keep in mind when we are thinking about bringing down the risk and the uncertainty with your mutual fund investments during such market conditions. Now, when you're doing a systematic transfer plan, you need to be cognizant. You need to take into account the taxation. So remember, we are basically talking about higher risk investments, and we are assuming that your investments were long term, which means if it was a debt oriented sort of investment, it had equity investments, but it was debt oriented in the sense that it was less than 65% in domestic equities, and it is taxed like a domestic, a debt investment or debt fund. So then if it's more than 3 years, then you get the inflation indexation benefits for the cost of buying the units. So then they get moved upwards, and you get taxed at 20%. For equity and equity oriented, where it's 65% or more in domestic equities, it's for more than 1 year, it's long-term capital gains tax of 10% for capital gains, annual capital gains made which is more than rupees 1 lakh. So all this you need to keep in mind when you're taking a decision. Now there are lots of ways by which you can do an STP. There are variants to it. One is you have a regular amount and you're taking the whole amount out. Okay, so if you've had enough of a very high risk thematic sort of a fund and you want to move out of it, so that's one way of it. So that's a regular amount. A regular amount is getting moved to a lower risk investment, so that's one way of doing it. The other is the capital gains. You only move the capital gains, the gains that you made, and you move it out. That's also a pretty smart move, and this is just in case your goals are far away. This is something that you should be looking at. You could actively consider. Then the other is in the destination fund. You're looking at the NAV. Depending on the NAV, you can have a mandate in terms of the movement. But that's for slightly more evolved investors. Now, the most important thing to keep in mind is this is clearly a financial planning exercise. It's not some kind of a tactical play that you'll do this and you'll gain something. It's a financial planning. You have a goals in mind and you're actually working towards it. So you're trying to make sure that you have steady returns, and because remember, STP will at least have 6 installments or more will be required. So you cannot be doing a sort of having a short-term view of STP in this case, in this particular concept, right? So these are some of the things that come into play when you are trying to use systematic transfer plan to secure your gains, secure in investments. Try to go to a lower risk sort of a paradigm and look at steady returns instead of very high returns. What you want is lesser volatility, steady returns instead of taking higher risk, higher volatility and higher returns. We sincerely hope you found this useful. If you've liked it, hit the like button, share it with others and subscribe to our channel. Till the next time, take very good care of yourself and goodbye.